Adobe has lost over $100 billion in market capitalization as investors worry about how artificial intelligence will impact the business longer term. Regardless, I wanted to do a discounted cash flow valuation analysis on Adobe stock to determine what's a fair price to pay for this business under pressure. So let's take a look. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. So three of the inputs I need to make this valuation is the market cap at 180 billion, the long-term debt at 5.6 billion, and the cash and short-term investment balance at 7.9 billion. I also need the average number of shares outstanding at 443 million, and I'm going to utilize the Wall Street analyst estimates for Adobe's free cash flow expectations over the next 6 years. The analysts on Wall Street expect the company to report $7.9 billion for fiscal year 2024, rising to $9.23 billion in 2025, $10.23 billion in 2026, $11 billion in 2027, $11.7 billion in 2028, and $14.7 billion in 2029. So despite the companies being pressured by artificial intelligence, the expectations are for the company's free cash flow to grow by billions of dollars, almost double the level since 2024. So despite the pressure, the overall growth in the market is expected to lift Adobe longer term. I also need the company's beta, which according to Yahoo Finance stands at 1.3. So now that we have the inputs, we can go ahead and jump into our financial model. Starting with 2024, the expected free cash flows of $7.9 billion, rising all the way to $14.74 billion in 2029. These increases in free cash flow I took directly from Wall Street analyst expectations and forecast. From 2030 to 2034, I created my own forecast for where I think the company's free cash flow will go in those next 5 years, and I used a growth rate of 6.7% to increase their free cash flows for those next few years. Starting in 2035 to infinity, I have the company's free cash flow growing at 5% rate during those years. And I choose this growth rate because this is the growth rate I expect of economies worldwide nominally, not real GDP. Real GDP likely to be around 2.5%. I'm also forecasting inflation of around 2.5%. So roughly 5% nominal growth for developed economies worldwide is my forecast. So since these are future cash flows, we need to discount them back to today. And the discount rate I'm using is 12.05%. I arrive at that by doing the weighted average cost of capital calculation. Remember, every business is financed with two sources, debt and equity, as some businesses use preferred stock, which is kind of like in the middle between debt and equity. But if you're financing a business, it's either debt or equity, and most businesses are a combination of the two. So since the market cap is 180 billion and they have total debt of 5.6 billion, I'm giving Adobe a target capital structure of 10% debt and 90% equity. Now, sometimes you might observe a company's capital structure being different than what they might want as the target capital structure. And it's because the company's management team is opportunistic in financial markets. If they observe, like they did in 2020, when interest rates fell to extremely low levels, companies will increase their debt. They'll borrow money at those opportunistically low interest rates, even if they don't need it at the time. They'll borrow it and they'll say, look, we can borrow billions of dollars at just 2 or 3 or 4%. That's an attractive financing option. Let's take that money. We'll find ways to use it, even if we don't have ways to use it right now. And the opposite is also true. When companies experience their stock prices soaring and they feel like that's ahead of expectations, they'll sell shares of their stock to raise money. And they'll say, well, even if we don't need it right now, we'll find profitable uses for this money a little bit down the line. Let's capitalize on our elevated stock price. And so management teams are opportunistic like that in the marketplace. So that's how I have the weighted average cost of capital calculated at 12%. So when I take the present value of all of those future cash flows, I get a value of operations of 173 billion for Adobe. To that total, I'm going to add the company's cash and subtract the debt, so I get a value of equity of 175 billion. And I'm going to divide that by the number of shares outstanding of 443 million. And that gives me an intrinsic value per share of $397 for Adobe stock. The current share price right now is $408. So $8 or let's say $10 is my intrinsic value per share difference from the current market price. And this is too close for me to say that the stock is overvalued. Usually when the price calculation is within 5% of the current market price, I call it fairly valued. And that's what I'm going to do in this case. I'm going to say that Adobe stock is fairly valued based on the current market price. Now, sometimes when I say that, investors take it to mean that the share price, it's going to be flat. Like if you buy it today and you hold it for 2 years, you should expect the share price to be the same over the next 2 years. And that's not true. What it means when you see a stock is fairly valued is you're going to get the expected return. The expected return based on the risk level of the stock. So in this case, the expected return should be something around 12% because that's my weighted average cost of capital is 12%. And my cost of equity I've calculated is also about 12.5%. So with Adobe stock being fairly valued, you can expect to earn about 12.5% per year for holding Adobe stock. Now, if I were to calculate this stock being undervalued, let's say my intrinsic value suggested it was worth $600, then you would not only get the return expected from the cost of equity, but you would also get the return expected from the convergence between the current market price and the intrinsic value. So you get two sources of return when the shares are undervalued according to intrinsic value calculations. Of course, this is all theoretical because nobody knows what's going to happen in the future. It's just what you would expect to happen based on these calculations. So I hope that explains a little bit on the meaning of a stock being fairly valued. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.